Hey friends, it's Iggy here from the Investing Iguana. Quick question to start. Are we just chasing this s-REIT rally or actually positioned for what's next? If you've seen those double-digit headlines and thought, did I miss the boat? You're not alone. Today, let's walk through this together, step by step, using my Substack article as our guide. We'll stick to the same flow so you can follow along whether you prefer to read or watch. And if you're new here, I've spent years breaking down investing in Singapore so you don't have to stress, especially when markets get noisy. Here's the plan for this video. First, we'll tackle the engine of the rally, interest rates, and why they matter so much to s-REITs. Then, we'll separate leaders from laggards and look under the hood at the operational health of top names. After that, we'll decode what institutions are doing versus retail. Then I'll share my buy, hold, and review/sell playbook, followed by the key risks to watch. Finally, I'll give a simple action plan you can use this week. Sound good? So, first up, the engine of the rally. Why interest rates matter. Over the past 2 years, rising rates were a headwind for s-REITs. Higher borrowing costs eat into distributable income. Plus, bonds look more attractive, and money rotates out of yield assets like REITs. Now the tide is turning. SORA, the 3-month compounded Singapore overnight rate average, has been trending down, and the US Federal Reserve looks set to start cutting soon. What does that really mean for us? Lower financing costs, better coverage ratios, and a more attractive yield spread versus bonds. That's like removing a weight vest from these trusts. Imagine the first table for a second. SORA sliding from the low 3s toward the mid 1s this year. That's a real tailwind. Then picture the second table, iEdge s-REIT index climbing month after month with Q3 breaking out to new YTD highs. The key idea here isn't line goes up. It's that the macro backdrop flipped from a drag to a lift. And when the cost of money falls, well-managed REITs pass that benefit into distributions over time. Here's the part I find especially important. This shift is structural, not just a one-day headline. That brings us to separating the leaders from the laggards. Yes, all 30 index constituents were green in Q3, but not all green is equal. The market is rewarding quality, especially Singapore-centric portfolios with steady footfall and office demand. Think of the top performers table: OE REIT CICT, Lendlease Global, Parkway Life, Fraser's Hospitality. The takeaway? The winners combine price gains with sustainable yield. But why does that number matter for you and me? Because price rallies without underlying strength fade. Price plus operating proof tends to stick. Now, let's look under the hood. Operational health of leading REITs. This is where it gets interesting. Imagine a simple grid with occupancy, rental reversion, and DPU growth. Keppel REIT shows double-digit rental reversion. Tenants are signing at higher rates. OUE REIT keeps occupancy high and DPU growing. CICT holds steady across the board. Lendlease shows progress too. Honestly, I used to get tripped up by this. Why fuss over rental reversion? Here's how I look at it. Positive reversion is the REIT's pricing power. It tells you demand is there and cash flows can climb even before rates move much further. A quick midpoint pause. By the way, if you want the reference tables, checklists, and the written version, everything's on Substack. The link is just below. It's the same structure as this video, so you can cross-reference anything you like. Next section, a critical signal. What are institutions doing? On the surface, you see a split. Retail investors are net buyers year to date. Institutions, net sellers. So, is big money dumping the sector? Not quite. Look closer and you'll spot something subtle. Institutions are net buyers of the high-quality names we just covered. Suntec, OUE, CICT. So the story isn't institutions out. It's institutions selective. They're pruning weaker names and concentrating in resilient leaders. Here's the part I find especially important. This kind of selective accumulation often marks the early innings of a quality-led cycle. Now to the heart of the piece, Iggy's playbook. Buy, hold, or review, sell. Let's go one by one so it's crystal clear. Buy quality Singapore-focused REITs. The filter is simple and strict. Singapore exposure, high occupancy, positive rental reversion, and a healthy balance sheet. If I had to name names from the article, CICT and Keppel REIT fit well. Why? because the ops data backs the share price, and institutions are showing support. If CPF or SRS is part of your plan, this is where the core could live. It's boring in a good way. Hold diversified s-REIT ETFs and existing leaders. If you already hold the broad ETF or the top names, there's no need to overtrade. Let the thesis play out as rates ease. I like to think of this as keeping a sturdy backbone in the portfolio, core exposure that does the heavy lifting while you fine-tune satellite positions. Review sell, REITs with high gearing or weak market exposure. Some US office tilted names bounced recently, but a relief rally isn't a turnaround. If the gearing is high or the market structure is weak, ask, would I buy this fresh today? If not, the current strength can be a graceful exit point. Rotate into quality and sleep better. Let's talk key risks to your investment thesis. 3 big ones. First, the Fed delays or reduces cuts. That would slow the rally's fuel line. Second, an economic slowdown. Weaker demand hits occupancy and rental reversion. Third, geopolitics. Risk-off waves can spark volatility and force selling. None of these are reasons to panic, but they are reasons to keep an eye on your sizing, your diversification, and your cash buffers. If I could give you one thing to remember here, you control position size. That's your first line of defense, your action plan. Let's make this practical. Step 1, audit your portfolio. Do your holdings actually meet the quality criteria, or are they just high yield on paper? Step 2, look beyond yield. Check occupancy and rental reversion. Are they trending right? Step 3, deploy new capital wisely. Dollar cost average into the ETF or a top-tier name so timing risk doesn't dominate your outcome. Step 4, stay informed. The Fed meeting on SEP 1617 matters. Not just the decision, but the guidance. Ask yourself after the press conference, did the rate path change your thesis? Here's my honest take to wrap up. In my experience, what matters most is matching the macro tide with operational proof. Falling rates give you the wind. Strong occupancy and rental reversion give you the sail. Sensible leverage is the hull. You need all 3 for a smooth voyage. Chasing the rally is tempting, but building positions and leaders calmly over time, that's how portfolios last. So if you're planning your next move, here's what I'd keep in mind. Focus on quality, let the macro tailwind do its work, and manage size like a pro. What are you watching this month? Drop a note in the comments. I read everything and reply when I can. By the way, if you want all the tables, deep dives, and early access to my sector watch lists, join the premium Substack community. It's the best way to support the channel and get the research first. Link below. And if you found this helpful, the next video I'd recommend is my breakdown of yield traps versus true dividend growers. That one pairs nicely with today's topic. I'll see you there.